on this development, we're also joined by Kian Soon, Chief Executive Officer and Fund Manager of Astral Asset Management. Thanks for coming in, Kian Soon.
Morning.
Morning.
So it's been a rough 24 hours for the markets. Pretty much escalation of this trade war on the currency front as well. What does all this mean for the markets in the near term?
I think in the past week, since the beginning of August, we have seen that the US markets have corrected. Global market have corrected as well in terms of prices, and it comes down between 4 to 5%, as we've seen across the regions. And this is a result of the trade war escalations coming from President Trump's tweet on the 1st of August. But people forget that the markets actually have a good time for the year of 2019. I mean, year to date until end of July, US have actually hit all-time highs for S&P. They achieved around 20 to 25% gains. Same for the regional markets as well, who came in more than 10% across the regions. So in response to the trade war escalations, I think the market is now, like previous responses, taking a hit. We're going to see that happening for the next few days, and we're going to see that ending probably in 14 to 20 days if there's no more escalations.
But certainly, doesn't it look like the game has changed a bit because now currencies are being put in the picture?
Okay, so if you look at the $7 mark, it was never a pre-agreed mark between any governments.
Psychological.
Psychological, because this was the lowest since the global financial crisis in 2008. The PBOC has came out to categorically deny that they will use devaluation as a form of weapon in the trade war discussions. And if you look at it, right, there are some analysts who say that basically China has given up on the trade war dispute resolution. They are doing this to give themselves an advantage in terms of exports. But seriously, China has less than 10% of its output exported since 2017. So in order to give yourself an edge up in terms of by depreciating your currency, it just doesn't make a lot of sense. Secondly, in terms of currency depreciation for renminbi, it could trigger a capital outflow from China, which is what PBOC do not want to manage. Last but not least, if you think about how China could respond to United States for trade war, I think the best way and the most simple and direct way is not to buy any farm produce from United States.
Right, because that would affect, of course, Donald Trump's re-election prospects, wouldn't it? But
voter base, yeah.
It's chaotic out there in the markets, as you well know. There's a saying, every crisis is an opportunity. I mean, China has traded low for quite some time now. I'm talking about the currency, but I mean, its stocks have been down for quite a long period. And Hong Kong is looking interesting. I mean, with what's going on the streets in Hong Kong with these ongoing protests moving into week 9, Hong Kong stocks is this morning getting pushed down another 2.8% or around about there. I did a quick check. There's many companies trading at P's of between 5 and 8. When you're trading at these single-digit P's, is that a value trap? I mean, or do companies look attractive when you're talking about some of the big blue chips at those sort of trading ranges?
So Hong Kong has actually found itself in a position of a perfect storm caused by 3 key factors. One is the trade war. Secondly is actually the China and Hong Kong economy slowdown, as well as the retail sales. Last but not least, the past 9 weeks of protests and street violence, as we have saw yesterday, that brought the whole Hong Kong to a standstill. So this is a perfect storm which causes the market to correct, as much as 6% and probably more for this month of August. If you look at the stocks that are listed in Hong Kong, there are a lot of companies that will be exposed to, the threats of protests. For example, the Hong Kong hotels, occupancy is all-time low. Hong Kong tourist-related industries and companies, the F&B sectors, and even the shopping malls. Because every time the protesters occupy these locations, it literally means there's no business for the companies. But there are many other companies that is listed in Hong Kong that is interesting. Hong Kong has play host to 3,000 listed companies that a lot of them, I would say, don't even have revenue inside Hong Kong. I think these companies offer a very interesting glimpse of what you can get as a form of value because, like what Arnold mentioned, they are currently trading at very low price-to-earning ratios. Many of them are single digits now. And this is a symptom of people running away in fear. And it's always a good time. Even as fund managers, we took this opportunity to basically buy the very interesting companies that we have done fundamental research.
Senator, so Hong Kong used to be like 18% of China's GDP, and now it is, what, 3% now. How much would the Hong Kong unrest play out when it comes to the economic sense in China?
I think the effect on China in terms of economy contributions to its GDP is tiny. However, the stability in Hong Kong is vital for the entire Greater China region, simply because Hong Kong represents a pivot in the Greater Bay Area projects, as well as the fact that China is concerned that the kind of violence we've seen in Hong Kong spreads to the mainland.
Just wanted to bring your point back. Just now you were talking about how there's opportunities in these Hong Kong stocks because, well, not all of them take their revenue from Hong Kong itself. Were you referring to them getting revenue streams from the mainland or further afield? And how might that be impacted or be a concern given that the yuan is weakening?
I think in terms of looking at companies that's listed in Hong Kong, there is a group of red chip companies as well as mainland revenue-driven companies that are listed in Hong Kong. And they will thrive, or their company's performance and fundamentals will thrive, depending on whether Chinese consumers are buying their goods and products. And in terms of having their functional currency as, Hong Kong dollars or US dollars, since they are listed in Hong Kong, the depreciation will have some impact. A lot of these huge companies have actually bought sufficient currency hedge for renminbi and Hong Kong dollars, so they are not likely to be severely hit by this impact of depreciation. As we see, right, this morning the renminbi has strengthened again, and for all we know, in the coming month, this is no longer an issue, and everybody forgets that China is a currency manipulator.
Time will tell.
When you look at the overall, fundamentals of the markets right now and seeing what's happening in the last few days with the purge in risk, does this hark back to late 2015, early 2016 when China's markets fell 3 weeks non-stop, or the GFC in 2008? Are there sort of any similarities you're seeing as a fund manager between sort of these pivotal times in the markets where everybody's panicking a little bit?
I think in 2015, right, I clearly record the plunge was a result of euphoria of stocks in China that has been surging non-stop for the past 6 months. And what subsequently happens is a huge plunge, which is a market reactions from the retail investors themselves, who actually ran for the doors as they see prices correct day after day. And even that, the cause and drivers for what has happened in China because of the economic slowdown then was very different from the situation today. We are worried about Hong Kong, looking at the slowing retail sales. If you look at the retail sales in China, it's close to 10% growth in the month of June. They have a VAT reduction of 3%, which basically helps Apple to clock its best quarter in China. They have personal income tax reductions for the Chinese consumers. So yes, the economy has slowed down because of the manufacturing sector, but overall I could see that the consumers are consuming, they are buying their automobiles, they are buying their houses. They are a bit concerned about the global headwinds, but the stimulus measures put forward by the Chinese government do really help to manage the situation this time a bit better.
At the end of the day, they're still opening up their wallets. Thanks very much for that, Kian Soon. Kian Soon, Chief Executive Officer, Fund Manager of Astral Asset Management.
Thank you. Thank you.
So we're going for a short break.